Hello, everyone, and welcome to another Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us here tonight in chat. We're really excited to have you guys with us here again this week. Got a lot of great information to go over, a lot of things happening in the market, and you guys are all in the right place. If this is your first time on, you'll notice that your microphones are muted. That's so we can hear Jeff and I talk, but there is a Q&A box in the chat box at the bottom of your screen. If you move your cursor, you put any questions in there, and we'll get to those throughout the session and also before we sign off at the end. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and also on YouTube. So if you're watching this on YouTube for the first time, like and subscribe our videos so you can get all of our weekly sessions as we're doing these every Tuesday at 7 o'clock. If you have any question about your account personally with Altos Trading or Trade Transillion or anything about your open trade alerts, email support@altostrading.com. We'll get to those questions that pertain to your account tomorrow. Before I bring on Jeff, let me just read a disclaimer. Altos Trading LLC and Trade Transillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading Trade Transillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, and accept responsibility for any decisions made by subscribers using the software and subscribers to the Trade Transillion software or any other persons who buy, sell, or hold securities should do so with caution. They consult with a broker or investment advisor before doing so. All right. Now the attorneys are happy. Let me bring on Jeff. Jeff, you there?
I'm here. Greetings and salutations.
Hey, how you doing?
Surviving.
Surviving. That's good.
That's
what we need.
On the right side of the grass.
That's right. That's right. So in Boise, do you have to cut your grass a lot this time of year? Speaking of grass?
Yeah. Well, once a week. I mean,
That's not too bad.
Unfortunately, we have a big lawn. I actually just bought a electric mower for the first time. I have a John Deere, but
as you should.
Yeah, it's the riding mower, so I can put my my beer in the cup holder beside me. But there, in the spring we get a decent amount of rain, so the lawn's kind of soggy. So I hold off on that till the summertime. But so I bought this electric push mower, and I'm actually pretty happy with it. Only problem is
wondering about that. Are they powerful or are they kind of
that's
weak?
The thing. They don't suck up grass as well as a gas mower. They cut it fine, but they don't suck it up. But that's fine. It's kind of like a combination of mulching and bagging. So it's fine, but they're a lot quieter. The real downside is the battery. I mean, I think it has like a 50-minute battery life, so I can't get the whole lawn done. And it takes like 2 hours to charge it. So you got to kind of forces you to take a break, I guess.
If you think about it, it's kind of nice because you got like a little built-in beer break. So it's like,
Yeah, exactly. Yeah. That's probably why they made it that way.
That's right.
All right. Well, welcome everybody. Sorry you had to listen to us about.
I know, right?
Talk about mowing the lawns, but it's my exercise. I don't go to the gym, so that's how I get my exercise is yard work.
Yeah, seriously. I was doing it too.
Yeah, it's that time of year. So, all right. Some funny comments. Welcome everyone. So today we've got some important levels to watch. One in particular that's been encountered since we met last Tuesday. So we'll map those out. Look at our as we get closer to the end of May, our 36 month moving average in the monthly charts, which at this point we've got a little ways to go, but and as we get closer to the debt ceiling limits and everything, we're actually looking good. So we'll want to keep a close eye on that going into June. And tonight's topic, I think we're going to have lots of time tonight for a ticker roundtable. So definitely get your tickers ready for tonight. But so it'll be somewhat of a brief strategy portion of the session, but hugely important. So I'm going to give you guys a couple formulas that, I personally, I keep on a notepad by my computer at my desk. Every time I, develop a strategy or trade place a trade or, analyze strategies or trades that I've made in the past. And it allows me to tweak them, optimize them, and because I do trade a lot of different strategies, ultimately determine, when you're mixing strategies within a single account, sometimes it can kind of be difficult to gauge, what's working, what's not. So it helps me determine that. So the formulas tell us, is our system or our strategy profitable? And typically we need some, a sample set, right? We need to have some trades under our belt we've actually placed using the strategy or system. And if it's a new one, the best way to do that is, very small. You can test things with real money in live markets with very small position sizes, not for the purpose of really making any significant amount of money, or hopefully not losing any significant amount of money too, but for the purpose of having forward tested data that we can analyze and then decide if it makes sense to continue using that system. So these formulas help us do that, and it's called trade expectancy. So we're going to talk about trade expectancy tonight, and it's a hugely underutilized aspect of trading. You could probably ask all your trading friends or anyone in the trading community and have a difficult time finding someone that utilizes this. Most likely they utilize a component of it. So often you'll hear people, talk about win ratios, like, oh yeah, I've got the system that wins 95% of the time. Well, that's interesting. Sounds good. That's one side of the equation. It's one part of the formula. But most of us know that you can have a system that wins 95% of the time and loses money over time, or you can have a system that only wins like 20% of the time and makes a lot of money over time. So there's more to it than that. So typically, again, what you see is people focus on one aspect of this formula and ignore the other, whichever that is. So we're going to look at the whole picture. And it's so crucial that we understand this and use it. And then we'll open it up to Ticker Roundtable and Q&A. So you chose a good week to be on. Great to have you guys here. And let's go ahead and map out our levels for the week. So we get into the end of the month, which, by the way, what is the last day of the month? Is that next Wednesday? So a week from tomorrow. We got another week of trade.
You know what, Jeff, before you get started, I love that you pointed out that fact about the win rate thing, because, doing this for years, we've been doing it, talking to thousands of students and subscribers all over the world. People get so hung up on win rate, and they believe it's like the be all end all metric that you should really be most concerned with in trading. And it's just like, no, it's just like you said, like you can have a 95% win rate and still lose money, because all your winners are tiny and your losers are huge.
Right.
And again, it's about finding that consistent strategy that works, that makes sense. So I love that you pointed that out, and you're going to get into that more, because I think people really emphasize too much on that, and that's really not where the action really is. So
yeah, and I'm also going to give you so even in addition to that, once we know the formula, we need to know how to interpret, what's a good system, what's the line in the sand, what's a good system versus not a good system. So I'm actually going to give you guys the number tonight that you want to hit, that the formula is going to spit out, to tell you whether the system is good or bad, because all systems fluctuate in performance with varying market conditions. That's not a bad thing. That's normal. So we need to know what number is the formula going to spit out that allows us to withstand, to ride out, the market, the behaviors of the market fluctuations, changes in volatility, all those things. So I'm going to give you that tonight too, so that you'll be able to run the formula, and you'll know, is this system and I think that's where a big part of that value comes in. Is sometimes, systems, you can have very good systems that can make a lot of money over time, and you hit a rough patch, and then you start to second guess it and wonder, and that's where this can also, be very valuable. Is if we know the math, we can be more confident in sticking to the system that, it's expected to produce a profit over a period of time, over a series of trades. And if that number, goes down, or if we have a series of losing trades, as long as the expectancy spits out this particular number or greater, we should stick to it. So that's also important. Yeah, Chris, exactly. Yeah, thanks for the reminder. Monday is Memorial Day, so we actually don't have a full week of trade left. We have Wednesday, Thursday, Friday, Tuesday, Wednesday. Thanks for pointing that out. Yeah, exactly. SPX failed off 4,200 again. Good observation. Yeah, we're going to talk about that. And likely because there's been some talk of some optimism around a solution of the debt ceiling, but there's really been no catalyst to really push the market significantly higher. So once we hit this 4,200 level, sellers came in. There's just not enough buyers or a significant catalyst to push us through. And I expected that to happen. That's why I wanted you guys to watch this so closely and told you to expect some degree of stalling price action or even a reversal off 4,200 in the past weeks that we've met. So that's what's happened here. So we're looking at the S&P daily chart. So that resistance is now held, and we can consider it, resistance still. It has it, because even though intraday we broke, and see, this is where these levels are so valuable, and where they can help you avoid getting trapped, like so many traders do. Is we had a couple days of trade above 4,200. Right? So May 19th, May 22nd. So think of all the people that got trapped here that entered. They're like, oh, S&P is finally breaking 4,200 on Friday the 19th, and then again yesterday on the 22nd. And what happened? Well, both days, sellers obviously faked out all the bullish traders and closed the day back below 4,200. So even though we had trade above that level, these are fake outs. And when you see, especially when you see consecutive daily fake outs of a key level, that was a very, very reliable warning of today's sell-off. So we had, again, Friday and Monday, trade above 4,200, closes below 4,200. So don't pay so much attention to whether it's a bearish or bullish candle. Pay attention to the close relative to the level. And so we got two closes. That's a warning of high risk of a sell-off like we saw today. Okay, so obviously probably not good news for anyone that was long the market, but aside from that, I like to see this because it helps emphasize what I hammer home, on every week on these sessions, and why it's so critical to watch these. So 4,200 resistance. Let's go ahead and mark that. So nothing's changed there since prior weeks. But now we're rotating lower. So we need to really be looking at support, which also hasn't really changed from last week. So the next lower century mark is 4,100. And this one will be a strong level if we get down to it. So just like I forewarned with 4,200 as a resistance, watch 4,100 as support. And be careful of any false breakouts if you're bearish. breakouts to the downside, just like what happened here, but in the opposite direction. Watch for that. If we do get a close or consecutive closes below 4,100, greater likelihood of further rotation lower. 40.50 is a level I'm watching to the downside if we have a sustained break of 4,100 support. And so watch these two. And with a few days left in the trading week, I think that would be sufficient for this week. I don't think, let's actually run over and look at, this is something we covered last week. Let's look at our probabilities of, let's clear that. Touching 40.50 on the S&P, the right window up here. All right, so we're going to look at statistical probabilities of touching 40.50 by Friday. So that's what, the 26th. All right, and we want to see to the downside where, so 40, well, let's look at both. Let's look at 4,100 probability of touch. So we have a 46% chance of hitting 4,100. But by Friday, we have a 77% chance as a probability out of the money of closing above 4,100. So that tells us that 4,100 century mark support level is quite strong, even visually speaking on the chart, but also statistically speaking, based on options probability. So probably closer to like an 80% chance S&P will close above 4,100 Friday. So that, again, how do I interpret this? Well, 46% chance of touching. All right, so it's almost a flip of the coin. So I want to be careful if it does touch that level. I don't want to get aggressive and jump into to a big bearish position, because there's a good chance, a flip of the coin chance, it's going to touch 4,100. But there's a much better chance of it closing above 4,100. When we go down to 40.50, because that's our next level of support, very unlikely we're going to close below that level by Friday. So we have almost a 92% chance of closing above 40.50 on Friday, and only a 17.15% chance of touching that price point by Friday. So those are important statistics. All right, so let's go back to our charts and look at the NASDAQ 100 QQQs. Which have really been on a tear, and we broke through this major swing high from back in August we talked about in previous weeks. So we've now had 3 closes above that level, right around 335. So that's the big transition here for NASDAQ 100 this week. It actually happened last Friday, but this was very strong resistance and has now transitioned into support. So 335 on NASDAQ 100 ETF, the Qs, 335, that area, that zone is support. So it could create buying opportunities if we get more of a retest and a bounce. But I don't like to buy near highs like this. Again, we haven't been up at these levels since mid last year. So that could definitely attract contrarian, traders and those who try to trap people who get in, long trades near highs like this. So I always want to wait for the pullback and then the confirmation of a resumption of the trend. So that's what we're watching on the cues. It's possible it could be a false breakout. The more closes we get above the level, the stronger it, makes this transition from resistance to support. And the more likely is we're going to stay above it for the near to medium term. But it's not out of the realm of possibilities that we could get a false breakout still. It's just not looking like it. But the catalyst that could obviously do that is any derailing of the debt ceiling progress. So just keep an eye, and if that happens, kind of right around the 322, 323 zone is also a level of support. Okay, here. Now, if we zoom out, since we're above a support level, where's our resistance? $350 is a big one for me. So we've had a weighted resistance level here with past rotations up into the level, right? We always, again, as we analyze these levels, are we coming up into the level or down into the level? Well, we had one that break through that ultimately resulted in an extended false breakout, but we had one coming up and then it failed and broke way down. So we've had some really big rotations lower from 350. So if this current leg up in the Qs gets up to 350, that, if I were to put on a long position, would be a definite profit taking level for me. Or, if I don't have any long positions and I see enough evidence of a bearish reversal off 350, might be a level I would initiate short positions on NASDAQ 100. So those are the critical levels on NASDAQ 100 and S&P. And then if we look at the VIX, where did my VIX go? There it is. So as we've talked about so many times, VIX, S&P inversely correlated. We had sell-off in the S&P and broader market. Well, not so much the NASDAQ, but that's definitely the S&P, but other indices as well today. And then, of course, we get the VIX spike. But VIX is still in lower territory, closing at 1853 and below 20, which is a major area of resistance currently, since we're below the level and moving up into it. So as things may get more volatile going into the end of the month and what's going on with the debt ceiling, this is the level to watch in the VIX. So what we want to pay attention to is the VIX moving up into 20 and then rotating back down, in which case we expect S&P to resume uptrend and hold that support level. Or does VIX just blow through 20, close above it, and S&P breaks that support level, ends up being a false breakout? Or if that happens like tomorrow, because S&P's already rejected 4,200 resistance, then much more likely we're rotating into those lower support levels we mapped out on the S&P, the 4,100 and the 4,050. So this paints that picture for us really well if we just look at them in conjunction with each other and how they correlate. All right, so yeah, that's our weekly levels to keep an eye on. And even going into next week, we want to see where the markets are trading relative to these support and resistance levels and what the VIX is doing in relation to the S&P and the NASDAQ. Any questions?
Yeah, got a question. Is the divergence cloud changing on SPX and QQQ here?
Let's take a look. So S&P, we still are in a green divergence, bullish divergence on the S&P. And let's look at the QQQ. Still bullish divergence on the QQQ. But we can also look at the charts and the shading to get a gauge. Still pretty darkly shaded, so still pretty strong bullish divergence on the Qs. Let's go back to that's still pretty strong bullish divergence. So this might just be a sell-off because of the resistance level on the S&P. Because I mean, look at the NASDAQ, right? We didn't see the sell-off in the NASDAQ today like we did, because this broke through resistance and held, whereas S&P what happened here? It's freeze up on me. Let's try this one. Okay, S&P. There we go. Obviously significant, much more of a significant sell-off. So it's likely because of these levels versus catalyst. You know, it's more emotional trading leading up to the debt ceiling issues. So this I'm going to take cautiously. I'm not going to. So personally, how I'm analyzing this is to me is probably a temporary pullback. Unless we break those lower levels, like you said. But yeah, we are still, or like I said, but we are still in bullish divergence. We're in a green cloud on NASDAQ 100 and S&P.
All right. Jeannie's asking if the buy and sell signal that are on the chart, is that AI?
AI, like artificial intelligence?
Yeah.
Our signals are don't qualify as artificial intelligence. They're algorithmic, so they read critical components of market conditions in real time, like volatility, ATR, average true range, trend strength, momentum strength, but they don't to qualify as AI. A lot of companies or trading educators or people that sell indicators or systems falsely name their products as AI. To qualify as AI, it has to have machine learning intelligence. So it's actually has to learn and self-optimize and adapt and stuff. And frankly, a lot of the things out there that say they're AI in the trading world are not. They don't qualify. So yeah, that's the signals don't learn anything. There's no intelligence behind them other than the intelligence behind the creators, I'd like to say.
Okay, gotcha. That's all I got for now on this. They're asking if you had a chance to look at the 36-month yet.
Oh, thanks for reminding me. Yep. I got sidetracked by going over to the S&P options chain and missed the 36-month. Let's go over to that one. All right. So what's interesting here is we just looked at on the daily chart. So now we're looking at a monthly chart. And we've just ever since we've gone into bear market conditions and encountered the 36-month moving average, I've virtually every week focused on this and how it historically serves as very strong dynamic support, which it's continued to do. And that's happening again this month. In fact, we haven't even actually come down and touched, but the 36-month moving average continues to reside very close to this 4,000 millennial mark on the S&P. Okay, it's at 40,1751. So it's above it, which is good for technical bullish bias. But in terms of price action in May, we were trading down around 40.50. So that half century mark held as support, which closely resides to the low level from April, right? So what I'm really looking for on the monthly chart for May here is, where are we going to close? I mean, it seems, unless we get a major like sell-off at the end of the month, it's highly unlikely we're going to close below our 36-month moving average, which means now for 1, 2, 3, 4, 5 consecutive months, we will have held this, because December was the last month we closed below December 2022. So I want to see, is there going to be indecision going into the summer months? Right now there is indecision, meaning that open and close are not far apart. Is it going to end up being more bearish than it is now? Like we have another leg lower, which is a possibility now that S&P has rejected 4,200. Or is this sell-off from today really just a temporary, kind of relief from the current rally, and it's going to attract people, buyers back into the market and push it up? So this May candle here on the S&P is very important to watch as well. And of course, then the monthly chart here allows us to also very clearly see this 4,200 resistance zone. And that's what ever since we've gone into bear market territory, struggled so had such a difficult time getting through on. We haven't had a single close since we had a close below 4,200, which was back here in April, right? Since previous all-time highs. April was the first month we closed. We traded below in prior months, but first close we've had below 4,200. And since then, we've traded above, but we haven't had a close back above. And interestingly, a lot of these months we're coming up into the level, and what this is telling us is that market participants on a whole, and probably most likely like big institutional money, doesn't have enough conviction or significant enough catalyst to inject bullishness into the S&P and push prices back above 4,200. But if that happens, and we do get a close above 4,200 and a strong close, and then particularly if it holds and we continue to rotate higher off, that's, as I've been saying for so many months, going to be our best technical clue of the end of, bearish to neutral market conditions, and more likely a resumption of a secular bull market. Okay, it could take some time. Obviously, it's not happening easily. Okay, because once again in May we broke through and then reversed lower. We could get sandwiched here for another couple months, especially entering summer months. We tend to get tighter ranges and less sustained directional movement. So that could happen over the next few months. We could be stuck in this for a while, but this will help clear that up, if that's going to continue happening, by looking at the monthly chart. Any final questions?
All I got.
All right. So let's talk about trade expectancy. It's a critical component to, as I mentioned when we started out tonight, analyzing whether your system is likely to produce, a profit over the longer term, and highly underutilized among traders. I think it's important to recognize that the reason we trade, there might be a lot of like personal reasons and etc., but the big reason we trade is to reduce our exposure to the market and give ourselves an edge. Because if you just buy and hold something, you're, basically at the whim of what the market does. If it goes way down, then you're way down. If it goes way up, then you're way up. Or if it doesn't do anything, then you don't make any money. Trading is the way to overcome that. And we can overcome it in different ways. We can trade directionally with the market. So if the market's going down, we can execute bullish strategies, or sorry, bearish strategies. If it's going up, bullish. If it's neutral, there are a plethora of neutral strategies market neutral strategies we can use. But it allows us to more easily adapt to market conditions because we're not in the market with one directional bias all the time. So that was a big, like, kind of light bulb for me. I mean, it sounds so obvious, but I had to remind myself about over and over again, especially when I'm, losing trades. And we all experience that, where it's like we might second guess our system, or, have doubts that stop us from trading altogether, only to abandon something that actually would have worked really well over the long term, and we just lost confidence in it. So this is where trade expectancy becomes so important, to make rational decisions versus emotional decisions. So it's not something that we should just use one time and call it good. It's something we should look at periodically, analyze on a regular basis, and make tweaks, adjustments, or maybe there are cases where we need to abandon a strategy or system and shift gears. And that's what it helps us do. So let's talk about what it is. We'll talk about the formula, how we can use it, all the critical things that will help us be better traders. So when we talk about expectancy, on a broad kind of explanation, it's how much money can we expect to make or lose for every dollar that we risk. So every time we put a trade on or enter an investment, we're taking on some degree of risk. And obviously we should be aware of that risk, but we should not just be aware of it, we should be aware of it in the context of how much we can make. So they go hand in hand. And what trade expectancy does is there's a formula that actually calculates our profit potential for each trade placed, and then also over a series of trades, so that we have an expectancy of whether the system will produce a profit over the long run, a loss over the long run, maybe it doesn't do much of anything, and then help us make a decision of whether it's effective or not, or whether maybe it's too risky, or maybe it's really good and we want to shift money from other asset classes or strategies or allocations that we have into something that has a high expectancy. So I'm going to throw a couple formulas out here. I'll just put them up on the chart here. Let's see. All right, so first we're going to look at expectancy. And expectancy is our, widen this out, our win percentage. So remember I said, like, people focus on win percentage, especially newer traders. They're like, oh, this system wins 90% of the time. It's got to be great. Oh, this system, and we, you see this a lot with people who start something new. We all get into something at the wrong time at some point. And our immediate, human reaction is that it's not good because we had a bad experience from the start. That's normal human nature, right? That's what we experience, and it started that way, and it's probably going to continue that way. But and I'll even tell you, like, we have services that have such huge positive trade expectancies, alerts that we send to our members over, almost a decade, like 8 years of data of real live trades that have huge positive trade expectancies. And if people just followed it and stuck to it, could make a lot of money with it. But we have people join it at different times. So if somebody comes in, they get in at a time where, hey, we have a couple losing trades. They email us back. The system sucks. It's not for me. I want my money back. That's reality. That happens. And then they leave, and then we hit 10 winning trades in a row. So something to keep in the back of your head when you try something. I'm not saying that if you have a bad experience that it's going to definitely end up in a positive one. Just think, am I making an emotional decision here, or am I actually using logic and trade expectancy to make a rational decision? Okay, so if we took a pause on somebody like that, started out just at a bad timing and paused for a second and actually looked at all the past results of the strategy or system, and then ran a trade expectancy on it, they might, have a second, think about it twice, before just saying I'm throwing in the towel. Like, okay, maybe I need to consider 2 trades means nothing. 5 trades means nothing. 10 trades really means nothing. Okay. 100 trades, that means something. Okay. 100 trades, that means something. So if you've done 100 trades and your trade expectancy is negative, get out. Or even if it's slightly positive, I'm going to give you the exact number to look for. But if it spits out a number below that after, 50, 75, 100 trades, don't use it anymore. It's probably not, very likely not going to produce a profit for you. All right. So sorry for the aside there, but okay. Expectancy is win percentage multiplied by our average win size. And then subtracted. So we do that calculation first, and then subtract our loss percent multiplied, oops, put that in parentheses. Multiplied by our average loss size. That's our expectancy. Okay, so as an example, like let's say we win 60% of our trades. Okay, and on 60%, we make $200. Okay, that's our average win size. So if we win 60%, we lose 40%. So we're winning 1.5 times the percentage of the number of trades we're losing. We lose 40%. But let's say we lose on average 500 on our losses. Okay, well, if we plug those numbers in, 0.6 times 200, 0.4 times 500, we're going to get, we're going to get a negative number. Negative, what would that be? 400, 0.6 times 200, 120, trying to do this in my head, minus 80. Okay, so with a 60% win rate and a 40% loss rate, that sounds good at first glance. And that's what most people look at. What's the win rate? Oh, you're winning a lot of your trades. 6 out of 10. I'm going to win 6 out of 10 trades. Oh, sweet. They're ignoring that win size. Or some people look at just the wins, average wins versus the losses. You can actually have average losses that are greater than average wins and have a very high positive expectancy. So that's the critical part of it. They have to be looked at in combination. So that a 60% win rate with an average win of 200 and an average loss of 500 would have a negative $80 expectancy. So what does that mean? That means for every trade we place, we would lose $80. So how could that deceive somebody? Well, I win six out of 10 trades. What if I get lucky and I hit 6 winners in a row? That's awesome. That's my expectancy, right? But when I hit the losers, then all of a sudden my losses are wiped out. That's what you typically hear people say. Oh, I hit all these winners and then all my winnings got wiped out. All they're saying is my strategy has a negative expectancy. They're just not saying it that way. They're just saying, yeah, I was doing so well with the system. I made a bunch of money and then I lost it all. So that's kind of like the novice way of saying I have a negative expectancy. So if you've experienced that, that's the reason for it. You had a negative expectancy. If you lose 80, if for every trade that you place, you're expected to lose money, you can still win money many times in a row. But over enough trades, you're going to lose on average $80 with that expectancy. So why would you trade it? Okay, so that's what expectancy is. Now, what we want to get to is the expectancy ratio. Okay, so this is kind of the first step. Let me back here. All right, so expectancy ratio is our risk to reward. Let me put this in parentheses too, actually. Risk reward so that's a ratio, risk reward ratio multiplied by our win ratio. Hopefully I'm not scaring everybody off with this math, but it's not that complicated. There's just really two things we're looking at here. And then we subtract the loss ratio from that. So that gives us our expectancy ratio. And this is the number that's important. That's going to help us determine, like, do we trade this system or do we abandon it? Okay. So again, expectancy basically lets us know, how much money can we expect to make on average per trade? That's what expectancy does. How much money can we make on average per trade? And to reiterate that where that becomes valuable is if we're analyzing the system and like we don't want to get caught up in the emotion of, oh, I just hit a string of winners or I hit a string of losers. I love this system or I hate this system. Because really all that is timing. You get in at a bad time, you get in at a good time. And the way probability curves work is even if you have a 50-50 chance, if you guys have ever done the flip a quarter exercise, we all know that you have a 50% chance of heads, 50% chance of tails. But you could flip 10 tails in a row or flip 10 heads in a row, right? But if you do it enough times, it's going to average out. So this is what the expectancy tells us. And it helps us not get caught in the trap of this system sucks, this system's awesome. It just tells us over enough time how much we can expect to make per trade. We trade because of that reason, because we're not buying and holding something. If we buy and hold something, we have a binary outcome as far as profit or loss. We either make money or we lose money. Trading is an aggregate of a large, series of individual trades. So if you're not using this, I would even go as far as to tell people is you shouldn't be trading. If you don't know what your expectancy is, do not trade, because you might as well throw darts at a dartboard. And most systems have a negative expectancy, unfortunately. So people end up losing money. All right, so we know what expectancy is. Now, expectancy ratio is important, really important. So it's going to tell us, and this is where, again, it's going to spit out a number for us. We have to have a positive expectancy ratio to stick with the system. Okay, so again, that's just our risk reward ratio. So that's important, right? Like if we're putting on trades, and this is another thing people get caught up on. Oh, this system, and I'll tell you right now, we send out trades that have a 2-to-1 risk reward ratio, meaning you're risking twice what you can make. Even worse, we have an option services that can have anywhere from like a 6-to-1, it's 10-to-1 risk reward ratio. You're risking up to 10 times as much as you can make on a single trade. And I can't tell you how many people see that and they're like, I'm out. Just because of that. What are they ignoring? They're ignoring the expectancy ratio. Guess what? I could show you 400 trades that we've done on that service and it's made money because it has a positive expectancy and a positive expectancy ratio above a certain number that I'm going to tell you in just a second. If you knew that, would you, I mean, it's like somebody handing you $100 and saying, no, thanks, I don't want it. You know, there's a tear in the bill. No, you don't want. That's an emotional response. Logical response is based on expectancy ratio. So RR ratio, that's our risk reward. So again, don't get hung up on that. If a system has a 1-to-1, you know, you always hear this like, oh, I don't trade 1-to-1. I want a 2-3-to-1 ratio. I want to make 3 times as much as my losers. Well, that would be nice, but it's not the whole picture. RR ratio, we need to multiply that by our win ratio. It means nothing. None of these mean anything by themselves. This means nothing without win ratio minus our loss ratio. That's going to give us an expectancy ratio. And that actually is a statistically significant number that will tell us over time if the system is worth trading. All right, so what this means is like if you risk $100 and you, so like, okay, let's kind of explain this. Let's just take, so let's say we have 300 trades that we're analyzing. We have 100 winning trades and 200 losing trades. So we're losing twice as many trades as we're winning. Okay. Let's say that we risk $400 on average, or we make $400 on average for every $100 that we lose. So we have an RR of 4. Okay. So that terrible win ratio isn't so terrible with our RR ratio. Okay, because if we run the math on that, let me actually just do this here. So let's see, we've got 4, it's our R ratio. We multiply that by our win ratio is only 33%. Then we subtract, so we're doing this first, subtract our win ratio, or sorry, our loss ratio. So we're losing 66% of our trades. Sounds terrible. It's actually going to spit out 0.66. That is a really good expectancy ratio. So what is the number we look for? 0.25. If we can get an expectancy ratio greater than or equal to 0.25, especially, and it's more significant the more trades that we run the formula on. You know, don't run it on 5 trades or 10 trades. So whether those are paper traded, simulated trades, I don't like to use it on back testing. Do it in, you know, if either risk very tiny amounts of money just to get the data, or trade it in the live markets paper money. Then you're going to get a reliable output here. If you do it back tested, you're not going to get a reliable output. So expectancy ratio of greater than or equal to 0.25, that is a good system. Well, what does that mean? That means that for every $100 you risk, you can expect to earn $25 of profit. Okay. So when you hear about like ROI, well, what's my ROI? Well, it would be 25%. That's a really good trade expectancy. Okay. 0.25 or greater. but that's what it means. If I risk $100, so if I risk $1,000, I can, for every $1,000 I risk in my trades, I can expect to make $250. For every 10,000, I can expect to make $2,500. So it also helps you set realistic expectations. Another, kind of a, fallacy that we often see, especially with new traders, like, I've got a $5,000 account. I need to make $1,000 a month. Well, if you back that out into these formulas, you would need a huge trade expectancy to do that. It's not realistic. So it's interesting as you like adopt this into your thought process, your trading, your approaches, and you start to hear people say these things like other traders, you're going to be far more knowledgeable than they are about this. And you'll hear when they say these things, you'll think about this and you'll be like, okay, that's not realistic. That's not realistic. That was a, irrational emotional decision. That may have been a rational decision, etc. That's what this will open your eyes to as you, adopt this and incorporate it. So as I mentioned, I have these formulas written down on my desk, right in front of me, even though I haven't memorized at this point. I still have them written down because it keeps me accountable to check, make sure I'm using them and not just doing them one time, and then just assuming everything's fine. I check them periodically to make sure. Does my system have a positive expectancy? Does it have an expectancy ratio of 0.25 or greater? Maybe it did for, a couple of years, and then it went from 0.2, let's say went from 0.30 down to 0.05. Okay, well, it's still positive, but I may want to really keep a close eye on this. Maybe it keeps going down, it gets negative. I need to make an adjustment to the system or abandon it. That's rational. Because in the course of being at 0.30 to going down to 0.05, which still would be a positive expectancy ratio, I'm still going to make money. It might be a little bumpier ride, but I'm not going to, because I hit a rough patch, be like, this sucks, I'm out of here, which is what you see happen so often. So rather than saying something is amazing or something sucks, use the formula. That'll tell you without any emotional bias whether that's true or not. If it's true, get rid of it. If it's not, set a realistic expectation of what to expect. And that's where the name comes from, expectancy. This helps us set realistic expectations for our trading. And that took way longer than I expected it to, but I kind of ranted there a little bit because I'm emotional about this. It's important to me, and it's frustrating to me when I see, some of our members even, but other traders out there that don't understand this or get hung up on maybe one aspect of this, approach or formula, and make a decision that wasn't the best decision for them. So this is why I ended up probably spending more time on it than I anticipated, and really want you guys to get a lot out of it and understand it and hopefully use it to help make better trading decisions. So I'll stop there and see if there are any questions or anything I can help clarify.
Let's see. Ed's asking some sort of a recap of risk reward equals risk over reward or reward over risk.
It's reward to risk. So, I mean, you could do it either way. It depends on how you analyze the number. But I would do reward to risk. So the first R would be your reward to risk.
Gotcha.
But really, all you need to what you need to make sure you know, like, so like, if you have a positive number here, like I use 4, that means that you're making 4 times what you're losing. If you get a negative number, then you have a negative risk reward. which is not, again, not necessarily a bad thing because it's relative to what your win and loss ratios are.
Yeah,
So it's the number it spits out that you don't want to be negative, or even below 0.25. So this 0.25, like if I were just starting out to use a system, or we're developing a new system, this is what I'd be striving for, or greater. You might dip below this, but again, as I mentioned in that scenario, like that's where I start really closely monitoring it. Might run this more, make sure, this might just be, a little blip and gets back above, but I want it to pretty consistently stay above 0.25 for the expectancy ratio.
Bill's asking, do you have like a record system that records the components you're describing? Like, do you do like a spreadsheet for this?
Yeah, I would do this with a spreadsheet. So like, what I do is like, because I keep, well, for instance, like all the alerts we send out to our members, like we track those diligently in spreadsheets, and I'll just stick the formula next to those on the Excel spreadsheet and enter it in. So the formula is already there in the spreadsheet. I could just type in, the updated stats, and it'll spit out my expectancy and my expectancy ratio. That's an easy way to do it. Absolutely.
Gotcha. Nalini's asking, can we review these weekly recordings somewhere?
Yeah, you can answer that. I'm not sure.
Yeah. So we have the members area, Nalina. I know you have access to that. You can get in there and look at some of the past sessions. We actually have all of our previously recorded sessions going back to 2018 in there. So there's hundreds in there, and also on our YouTube page. That's a quick and easy place to find it, is on YouTube. So if you guys are wanting to see any of our past sessions, or you want to catch a replay of this, if you came in late, or you want to kind of rewatch this piece over again, and I do recommend watching these teachings more than once, because you'll always pick up something that you missed the first time around, and you hear something differently. I host these with Jeff. I'm on it with him. I edit the videos, and every single time I watch them, I pick up something new every time. So yeah, I definitely recommend you guys watching them more than once moving forward if you do. All right, that's all I got.
Any final questions? No finals. Okay. Well, again, I went longer on that than I expected to. I thought we were gonna do that in less time and have more time for ticker roundtable, but since we ran over the hour, let's set aside and commit to time on Tuesday, which I think will be a good day to really do that as we get into the end of the month. And of course, the markets will be closed Monday for Memorial Day. It'll be nice to come back fresh next week at the first day of trade, and look at whatever you guys are watching, what you want to know in terms of levels, and we can go back and focus on some of the topics from this week, like trade expectancy, or previous weeks, key levels, probabilities, and do some deep analysis on what you guys are watching, and hopefully help you make your more informed trading decisions. Obviously, we can't tell you what to trade or how to trade it, but we can at least help you make more informed trading decisions. Why we're here. So I hope you guys got a lot out of that tonight, and you have my commitment next week on Tuesday to focus on ticker roundtable as we get into the end of May and start out June. So any final questions before we sign off?
No, it just looks like there's a ton of people in here just saying this was really interesting, really great discussion. Really glad that you covered this. So I think it was a wonderful teaching tonight for everybody. So thank you guys for paying attention and asking such great questions. And thanks to Jeff, as always, for sharing all this wonderful information. You're just not going to get it anywhere else. So you guys got to keep coming back week after week. Oh yeah, before we do sign off, Jeff.
I know exactly what you're thinking of. I totally spaced it again, but we meant to ask you guys something last week, but yeah, Richard will let you know.
Yeah. So what we've been thinking of doing lately is really kind of putting the focus back on you guys. Again, as our students, really covering the things that you guys want to cover, and the success we've heard from people, like so many emails, so many comments, so many things that have been really great. And we were like, we always hear from Jeff and you hear from me, and we thought that everyone would love to hear from you. So what we sent out last week was an email, kind of just asking you guys, what your success was with us and what you guys thought about Altos trading, or if it's a particular alert service or coaching program or something that's made an impact for you. We set aside a page that we set up, and you can basically submit like a short little survey about yourself, and we're going to receive all of those, look those through, and Jeff is going to be conducting these 30-minute one-on-one kind of private interviews with you guys to kind of learn more about you and what's worked and what's helped you along the way, so that we can kind of help show other members, that there's parts in your path to being successful in trading. And there's milestones and steps, and we all reach those at certain times. And we would just love to hear from you guys, your story, your journey, what you find that's helpful, that we offer, and just to kind of share amongst the group. So we put together a page for you guys. I'll put the link in the chat box. Jeff, if you want to add anything else to it, but essentially that's what we're looking to hear from.
Yeah. I think Richard summarized it really well, and it's a good opportunity, like, for you and I to connect one-on-one if you guys are interested in that. And it helps us a lot. Like, it helps us tailor our coaching, develop new services that are of importance and interest to you, and all these things. We set aside 30-minute time slots. They don't necessarily, have to go 30 minutes, but some might go 5 or 10, and but we at least want to give you guys that much time with me, one-on-one, if you're interested. And for your time, because we realize it is a time commitment, if we end up conducting a session with you, we compensate you with a $50 Amazon gift card, as a thank you for providing your feedback. And then again, it really helps you guys and the trading community. It helps us help you. So that's really what the purpose is. We have it. We have like flexible time slots, so we give you an option of different days and times that are convenient for you. So you're not like, we're not going to, if you decide you're interested, we don't force it on you. You can select one that works, or if one doesn't work, then no problem. We can work with you and figure something out if you do want to move forward with that. Yeah, Richard, did you want to put the link to that in the chat box or the Q&A box?
Yeah, I did. I put it in the chat box.
Okay.
If you guys want to see it there. And also, like, we're not just going to blindly post it. Like, after we're done, we're going to send it to final approval on us sharing with everyone. But yeah, we just really want it to be a positive thing that, again, it gives back to the rest of the trading community. It's everyone to hear, where you guys are, the success you found on your journey. And again, like as Jeff said, we want to take those opportunities to improve what we're doing. If you guys like something that we're doing and it's working well, then we want to do more of that. If you have ideas that maybe we can do something differently to help be better and help you guys more, then we obviously want to do that. So
yeah, definitely. Awesome. All right. Yeah. So Richard got the link in the chat. With that, I want to thank all of you for joining tonight. Again, my apologies for not getting to take a roundtable. It happens once in a while. For those of you who join us regularly. But again, I'll commit to that next Tuesday. So I hope to see you back then. Have a great rest of the trading week. Remember, as I think it was Chris reminded us, Memorial Day is Monday and markets are closed. All right. So we'll see you next Tuesday. Take care, guys.